Hi, in this video, we will be talking about the two most popular methods of investing in mutual funds, that is via the SIP mode, that is the systematic investment planning mode, or via the lump sum mode. Also, we will understand as to which option is better, that is whether to go for SIP or lump sum. Traditionally, people would invest in a fund by depositing a lump sum amount in the scheme. However, with the risk associated with the giving away a sum of money on a long-term basis, highly risk-averse investors stayed away from funds. Because of this, the mutual fund industry developed a systematic method of investing in funds for such investors. This method is most popularly known as the systematic investment plan or the SIP. So what is an SIP? The term SIP stands for systematic investment planning. It is a periodical form of investment wherein the investors can invest an amount of their choice on a monthly, weekly or quarterly basis. So how does an SIP work? Well, at a fixed date, every month, week or quarter, the money we deposit is used to purchase units of the mutual fund scheme as per the NAV or the net asset value on that date. This amount is usually lesser in comparison to a lump sum investment, and the minimum amount most schemes accept for an SIP is Rs 500. Apart from the minimal investment, another benefit of SIP is the benefit of Rupee Cost Averaging. If the net asset value or the NAV falls, we will be able to purchase a higher number of units than before. Let us understand this with the help of a very simple example. Now suppose you have decided to set up an SIP of Rs 1000 per month and the NAV on that date is Rs 50. Therefore, you have essentially purchased 20 units of the fund. Now what will happen if the NAV falls to Rs 40 next month? Depositing Rs 1000 can get you 25 units of the fund. Therefore, when the NAV will rise in the future, the value of your investment will increase due to the increase in the number of units. An important question now arises as to which one is better, whether you should go for lump sum or an SIP. Well, the answer to this question depends on two criteria. Now, the stock market is constantly changing, which means it's volatile and it's difficult to keep the track of the market. So when it comes to stock market conditions, it is seen that a lump sum performs better than an SIP when the stock market is at the constant high. Conversely, with Rupee Cost Averaging, SIPs perform better when the market is constantly declining. Such constant market conditions are rare. So let us look towards the second criteria to answer our question. Now, a lot of us investors belong to the working class, and therefore it is impossible for us to constantly keep track of the market. Therefore, with an SIP, we can be assured of the uninterrupted investment without the hassles of having to do it ourselves. Additionally, when the market seems to decline, a lot of us might feel panicked and we might want to withdraw our investments. Well, here an SIP helps us to keep ourselves calm by automatically investing for us and spreading our investments over the period of time. Therefore, the SIP is better and an easier way for us to invest our money over time. Thank you for watching the video.
Investment in the securities market are subject to market risks. Read all the related documents carefully before investing. Such representations are not indicative of future results.